Hello and welcome to the latest Insider interview. Our guest today is Simon Gergel, manager of the Merchants Trust. Simon, thank you very much for coming into the studio.
Hello.
So could you please tell me a bit about how you invest? What are you buying and what's the goal of the investment trust?
Yes, well, the Merchants Trust has been around for 133 years, and the goal is to deliver a high and rising income stream along with a good total return, investing in UK equities, predominantly large cap UK equities. So what we try to do is we try to identify companies that we think can have three factors. We want companies that have strong fundamentals, so a good business, strong competitive position, strong balance sheet, strong financial position, and so on. We want companies that are cheap compared to their history or compared to other companies we can buy. And then thirdly, we don't just want good companies that are cheap, but we want companies that ideally have a very supportive end market dynamic. We call it a theme, like a demographic change or the way digitalization is affecting the industry. And if you combine that, if you can get a good company that's cheap, but with a supportive end market theme, that can be really quite powerful. If we build a portfolio of those companies with a good yield, hopefully we can deliver a good total return and a good income as well.
Is your aim to find companies that pay a high dividend today, or are you perhaps looking for companies that can grow their dividend?
It's a really good question. We yield just under 5%, so significantly more than the stock market in general. We try and buy companies that have a good yield, but we never let the yield drive the investment decision, if that makes sense. We always buy companies where we think we can make a good total return. So we fish in the pond, if you like, of high yielding companies. But once we own them, we're not concerned whether that dividend in particular is growing fast or not growing much at all. We want to buy companies where we think we can make good money. And if we can make good money on the underlying company, ultimately we can either get dividend growth from that company or we can reinvest the proceeds to get dividend growth elsewhere. So we are much more focused on buying really good companies that are cheap, that we can make money in, than that every company in the portfolio has to grow at a certain rate. That's not our focus.
And the trust
Sorry, when I say grow the dividend, yeah.
And the trust is a AIC dividend hero. That means it keeps raising its dividend, and you've got a more than 20-year record of doing so. So how many years have you been raising that dividend, and how did you manage to do that during COVID, where lots of the dividends actually weren't paid?
That's another good question. So the trust has raised the dividend for 41 years, which is longer than I've been managing it, so my predecessor and me. And the way investment trusts are able to operate and do this, have these really long-term records of raising the dividend, is because the directors can take money in good years, if you like, when the sun's shining, put money in reserves, and then draw on those reserves in the difficult times when it's raining to keep paying a growing dividend. So as you're right, in COVID, well, before COVID, we were putting money away into reserves. The directors were putting money every year away. And then when COVID hit and income fell by about a third for the first year, the directors dipped into reserves to keep paying a growing dividend. We've come through that now. Income has recovered in the market, and the dividend was once again covered at the last year. So we've got through that, and we can start rebuilding those reserves again.
So how are those reserves right now? If we had another period where dividends dried up for whatever reason, would you be able to keep raising the dividend? And would that be a real priority for you?
It is a priority to keep paying a growing dividend, but not at the expense of the sustainability of the trust ultimately. But we have 16 pence per share in reserves at the end of the last financial year, which is about just over half of an annual dividend of about 27.5p. So you can see there's still quite a substantial reserve position there.
And where are you finding the best income opportunities today? What sectors are you investing in?
Well, we're finding opportunities across different parts of the market, actually, both in domestic companies, international companies, because the UK stock market has a lot of international earners, in some defensive industries like pharmaceuticals or utilities, so industries that aren't particularly sensitive to the economic cycle, but also in the more cyclical areas. I think in particular, given how nervous the stock market is and how polarized it is, how you've got a big gap in valuations, we're finding particular value today in some of the more economically sensitive areas like house building, building products, consumer services, retail. We're finding some really interesting bargains in those areas because a lot of investors are shunning those areas and shares might be out of favor. And we can find some companies that are really strong businesses on a 2-3 year view. They're going to go through a difficult time, some of them. And that means that the shares are offering really good value in many cases. So that's where we found the best value today, those more cyclical, more domestic areas. But there are actually opportunities across many of the sectors. I mean, other areas could touch on, banks, energy companies, they all look good value as well.
Let's go back to those cyclical bargains. So which types of companies are you buying and what are the yields on offer today?
We've bought quite a few companies which make building products, everything from bathroom showers and taps to roof tiles and paving stones, and in fact doors and components for doors and windows. Yields typically 4, 5, 6%. Actually, they can be higher, but they are generally quite high, and profitability has been good. The companies are generally quite lowly priced. But the concern, of course, is that profits are going to come down because trading is going to be more difficult in those building and repair and maintenance industries. So I think you've got to be a bit careful with looking at the valuation today in terms of the multiple, how much you're paying for the profits, because those profits might come back down. But if we look through the cycle and say, okay, in 2 to 3 years' time, as the industry recovers, the valuation multiples look really, really attractive, really sensible to us. And the other thing I would say is we know there's a shortage of housing in the UK. We need to build more homes. So at some point in the future, house building will pick up again. And actually many of the companies, I haven't said this, are global. So they've got operations in the UK, but they've also got operations, some of them in Ireland, a lot of them in America have got big operations. And the markets are different there, different cycles, different opportunities.
So which specific companies do you like in the building and house building space then?
Well, we've got companies like Grafton, which is a distributor of building products. It's got a leadership position in Ireland, in DIY and also in builders merchants, but it owns the Selco brand in the UK, which you might know of. We've got a company called Norcross, which makes bathroom tiles and showers, taps, those type of products that it's consolidated some quite fragmented markets. It's got some really strong brands. We've got a company called Tyman, which has got a very large presence in America. It's the market leader in making components for doors and windows. The balance is when you have a double glazed window and the locks and the bits of metal, the hardware that go around it, they've got a very strong, sort of like a 40% market share. And we're quite optimistic about the US housing market. So there's a number of companies in that area.
Shell and BP, the oil and gas sector is important to you. Why do you like that area? And are you worried that a falling oil price linked to economic concerns globally, especially in China, will impact their ability to pay dividends?
Well, interestingly, we had a meeting with the chief financial officer of Shell this morning in our offices. The businesses are generating a huge amount of cash at the moment. Oil price has come back, as you say, from where it was, but Shell believe they can cover the dividend even at $40 oil. The oil price is currently about $70. And we are relatively positive about the outlook for oil and gas prices in the medium to long term, particularly because there's so little investment going in. There's a natural cycle in oil that normally when prices go up, investment goes up in the industry, more resources are brought to the market, and the price then falls because the market has lots of supply. That hasn't happened this time round. Most companies have held back their investment, focused on cash generation, and demand and supply is pretty tight. And so, yes, there might be a short-term drop in the oil price because the economy is weak, but medium to long term, there's not going to be enough hydrocarbons probably, and their prices are likely to remain firm. And clearly, we saw the tragic invasion of Ukraine last year with Russia push the gas price up hugely in Europe, and I think there's still going to be shortages for the next 2 or 3 winters because of that. So I think we're quite positive on the outlook for oil and gas prices, but certainly for the companies that are generating very strong cash flows on the back of it.
Tobacco is another sector that you like. A bit like oil, some investors steer clear of it. But why is it great for dividend seekers?
You'd have to give you a very long answer on this one, potentially, but in essence, these companies are generating a huge amount of cash. The number of people smoking every year is declining, but they're able to raise prices to offset that and keep growing the profitability. And at the same time, they're starting to build the next generation of products which are less harmful, so vaping and heat not burn products, which the problem with cigarettes, the main problem with cigarettes is the burning of the combustion of the cigarettes creates a lot of bad chemicals, toxic chemicals which are harmful. If you can take that burning out of the process and have vaping or heat not burn, they may be less harmful products. And as the industry gradually repositions, they might become hopefully more sustainable with products that are less harmful. But the other thing about tobacco companies is they are extremely lowly priced because investors are concerned about the sustainability of the business and how long those cash flows can be around for. We think the cash flows can be around for many, many years into the future. So we see a good opportunity there.
Another big investment sector for you is financials. We've seen interest rates hit 5% now in the UK, but the economy could be weakening. How do you assess what is a good financial stock to own for income?
Well, the first thing to say about financials is it's incredibly broad and heterogeneous sectors. So we've got companies in there like IG Group, which is an enormously profitable spread betting company. We've got fund management companies, we've got banks, we've got insurance companies. They all often have different cycles and different factors. We're seeing, if you take insurance, we're seeing very rapid rises in insurance premiums, which should be good for their profitability going forwards. Banks have been completely restructured since the financial crisis. They've got less debt, less leverage, and stronger business models than they had previously, and they're generating lots of cash. So we're finding lots of opportunities there. Interest rates rising is a double-edged sword for many financials. Often they benefit from, if you're taking a bank, they can benefit because they can make a better spread between the depositors and the lenders. But there's a risk, as interest rates go up, there's a risk of bad debts picking up. So you have to look sector by sector or subsector by sector and even company by company. But we do find lots of opportunities in financials at the moment. And interest rates going up is not necessarily a bad thing. In fact, for some of them, it's quite a good thing.
Simon, thank you very much for coming to the studio.
Thank you very much.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.